My name is Tom Clendon and I am an ACCA SBR subject tutor. And the video you are about to watch is on the tricky topic of financial instruments. And I think we'll all agree that there's no trickier topic than financial instruments. I hope you enjoy the video. I hope you learn something. It's good to watch it a second time. It's good also to have pen and paper to hand and be prepared to pause the video, so you can work along. I hope you enjoy the show. Financial instruments are contracts that create a financial asset in one entity and a financial liability, in other words, debt, or an equity instrument in another. And this tricky topic video is all about that debt and equity aspect. I'm not going to be talking about financial assets today. So one of the things we're going to be looking at is whether it's debt, whether it's equity, and how we account for them in very different ways. And finally, we'll be looking at compound instruments and how we apply split equity accounting. First things first, let's have a look at debt. You intuitively know what debt is. It's money that you borrow, it's money that you have to pay back, and you have to pay back more than you borrowed in the first place. So bring that intuition to bear. The formal definition of debt, 90% of the time, revolves around a contractual obligation that we have to pay cash back to somebody. But it can involve also contracts which are unfavourable, or contracts where we're having to settle them by the issue of a variable number of our shares. If it's a fixed number of our shares, if it's fixed number, fixed amount, then it's going to be equity, as we'll see. So, back to basics. Initial recognition. You're borrowing money. We are receiving money. So we debit cash. Cash goes up. And we are recognizing a liability. We're recognizing a non-current liability. If we've decided that the instrument is a debt instrument, not an equity instrument, we've raised finance, we've issued a bond, we're debiting cash, and we're crediting liabilities. That's the initial recognition. And the subsequent accounting for this is amortized cost. That's the terminology that is describing what I'm about to say. If you borrow money, it will cost you. And there is an expense that you must charge to the profit and loss account at the effective rate. And when interest is added, when that finance cost is added to the liability goes up, that's the credit, and there's an expense in the P&L. That's the normal way of accounting for a finance cost. And when you pay money back, when you pay money back to the person who lent it to you, when you repay cash, when you pay the interest, the liability goes down. You credit your bank, money goes down, that asset goes down, but you're debiting the liability goes down as well. And at the year end, this yo-yo has occurred because the liability's gone up with the finance cost, has gone down with the cash repaid, and you're left with a closing balance. And that closing balance at the reporting date is left alone. It is not revalued, which is why we call this amortized cost. Just because it's a cost, it doesn't mean it doesn't change, but it is not being revalued. Let's have a look at an example, because this exam is about explaining and application. We are fish, and we are issuing a bond. We're raising finance. We are receiving cash. and the 10,000 is the nominal value, and we're issuing it at par, which means we are physically receiving $10,000 on a 2-year basis. It will be repaid in 2 years' time. That is the nature of debt. It's a fixed term relationship. Now, the coupon rate refers to the cash that we pay. So 5% on the 10,000 is 500. Yeah, you can just do that in your head, I hope. So we're committed to paying 500 cash back in the first year and 500 cash back in the second year. But that is not the finance cost, and the effective rate of interest that we have going to experience in this instrument is 8%. Don't worry, this number is given to you. Yeah, we're accountants, we're accounting for what has happened. We're not having to work out the effective rate of interest. So the effective rate is 8%, and that's going to be used to determine the P&L finance cost. Now, finally, in order to make sense of this arrangement, you have to redeem the debenture at a premium. You have to pay back the loan with a little bit of extra money at the end, because nobody's going to lend you money if you only pay them 5%, when effectively the rate of interest in the real world is 8%. So there's a backloading, there's a lump sum at the end, there's a premium on the redemption. So how do the numbers work? Well, you start with an opening balance of 10,000. These days, we're not going to be doing T accounts. All right? This is how you would prepare. This is how you would show, if you wanted to, the numbers that's going on. Now, the effective rate is 8%. So you're going to have a charge of 800 going through the P&L. That's an expense that will increase the liability. You're going to be paying back 5% on the coupon rate. The coupon rate is 5%, 5% on the nominal value. So you're paying back 500. And this means the liability is beginning to get bigger each year. So at the end of the year, it's 10,300. That's the closing liability. And in the meantime, if you think about the financial statements, your expense is 800. The cash that you're paying is 500. And the closing balance is 10,300. I want you to be really comfortable with amortized cost. And rolling into year 2, you start year 2 owing 10,300. And this is where we have compound interest. The finance cost now is 8% on the 10,300. So that means that you've got a larger cost than the year before because the debt is slightly larger. We're still going to pay off 500. Now, because this is a simple example, because this is a 2-year story, we're not going to end with the closing balance now. We're actually going to be redeeming the debenture, paying back the loan, paying back the bond. These are interchangeable terms. You can call me Tom. You can call me Thomas. You can call me Tommy if you really wanted to, and I would respond to all of those. We are paying back the 10,624 because we are paying back the debt at a premium of 624. And that ultimately means there is no closing liability at the end of the second year, because we have contractually done what we said we would do, which is to pay back the money. So this is a beginning, middle and end story in terms of amortized cost. Equity. When we are issuing financial instruments to raise finance, we can think of them as either being borrowings, debt, raising money that we have to pay back, or we can think of giving away a slice of the business. Yeah, issuing shares, issuing equity. And both of them are similar in that we are receiving money to raise finance, but the accounting treatment is very, very different. Now, the definition of equity, it revolves around the ownership interest. The definition of equity, it revolves around not having an obligation to pay the money back. Strictly speaking, it's a contract that evidences a residual interest in the assets after deducting all of its liabilities. So you have no obligations in respect of equity. That's the key point. That's the key point. When you issue equity, you are receiving money. When you issue equity, I'm keeping it simple. You can do share for share exchange, but let's keep it simple. Debit cash, credit share capital, credit equity. In the old days, you might say share premium. Yeah, but we tend to say just share capital or other components of equity if there is a bit of a premium. The initial recognition, money comes in, top of the balance sheet goes up, equity goes up, we've issued shares. We've issued shares which we've classified as equity. So that's the initial recognition. The subsequent accounting? Yes. No. That's it. The subsequent accounting, there is no subsequent accounting. When you issue shares, you don't add on a finance cost ever. When you issue equity shares, they don't go down when you pay when you pay interest or pay a dividend. When you issue shares, they don't go and they go up and down in value in the market. You don't capture that. There is no subsequent accounting for equity. It just stays. Yeah, it just stays. Mirror, mirror on the wall. Who is the fairest of them all? Meaning, if you're issuing a financial instrument and it's got to be classified as debt or equity, what would the creative accountant want? What's going to make the financial statements look better? Let's have an awareness of that as an issue. If you classify a financial instrument as debt, then your gearing goes up. And that means that your liabilities are going up, so it appears that you are a more risky enterprise. It also means that you've got a finance cost running through the P&L, and that will reduce the profit. On the other hand, if you classify something as equity, because you've increased the equity, the gearing, the perception of risk of the business goes down. And any money that you pay to your shareholders doesn't go through the P&L. The money that you pay to your shareholders are classified as dividends, if it's equity, dividends, and dividends are part of your reduction of retained earnings. They're not an expense in the P&L. So the general conclusion is that I would prefer to have an instrument classified as equity because it strengthens the balance sheet without weakening the profits. Whereas if it's classified as debt, you've instantly damaged the strength of the balance sheet and the potential future profitability of the company. So debt is ugly. Yeah, equity is pretty. I suppose there's one little thing I could add that sometimes people think equity is not pretty in that it causes a dilution to the existing shareholders. So some existing shareholders wouldn't necessarily regard the classification of an instrument as equity as being pretty because it dilutes their holding. But that's quite a technical point. But we are dealing with tricky points, aren't we? And if we're dealing with tricky points, we've got to understand the distinction between debt and equity in that classification process may not be clear-cut. That a fundamental characteristic of useful information is that we've got to be a faithful representation. which means we've got to apply substance over form. So the accounting standard on this area, which happens to be ISA 32, says, look, consider the truth. Consider the substance of what is going on when you come to classify an instrument that you've issued as to whether it's debt or whether it's equity. And for me, the best way of explaining that is in the context as you are going to be tested. So FAL has issued some preference shares. Preference dividends are only required to be paid in the year that dividends are paid to equity shareholders. The preference shares contain a call option. Now this enables us, FAL, to call back to redeem the shares if it so chooses. Do you think the preference shares should be classified as debt or as equity? And why? Can you justify that? Maybe you would like to pause the video at this stage to think about it. Now, if I'm trying to earn 4 marks, I really want to try and say 4 things. Now, in an exam, these would all need to be slightly elaborated and developed. But in principle, we can start with a little bit of a soft, applied definition. You know, that FAL will classify these shares as debt if they contain an obligation, but as equity if they evidence ownership interest, if they evidence a right to assets after all the liabilities are paid off. You've got to be careful you don't write too much, but you can start by setting out a little bit of a theoretical stall. But now we've got to look at the application. Preference dividends are only required to be paid if an equity dividend is paid. But you don't have to pay an equity dividend. Therefore, you don't have to pay a preference dividend. Okay? So there is no obligation to pay the preference dividend. Now, the call option. If it's a call option, it's FAL that has the power. It's FAL that has the choice. It's the issuer that is in control of whether or not the option is exercised. Now, there's no suggestion that they're going to be forced to do this. It's very open-ended. If it so chooses, if it so chooses. So there is no obligation under FAL to redeem these shares. Yeah, the call option has not created an obligation. And therefore, in structuring my answer, I've started with the theory, I've then applied it, and I'm reaching my conclusion that for FAL, these preference shares would be regarded as equity because they contain no obligations. All right? Second example. Fish. Fish has also issued preference shares. But these preference shares contain a put option. Now, the put option gives the power to the shareholders to require Fish to redeem the shares at any time at the original amount paid, subscribed for, plus 4%. Yeah? Less any dividends that may have been paid. That's the setup. And we are crudely having to decide and explain how Fish should account for these preference shares. I wonder if you think that Fish should show them as debt or Fish should show them as equity. But in the exam, it's not necessarily about coming up with the right answer. It's about dealing with the logical points, weighing it up. Yeah, it's not 4 marks if you say the right answer and no marks if you say the wrong answer. It's building up your answer. You may want to pause the video at this stage to think. But if I'm earning 4 marks, once again, I would think about earning my first mark by setting out my stall, by saying that Fish has a decision to make as to whether they're going to be, the preference shares are going to be debt or equity, and that we should follow the substance of the arrangement, and that it's debt if it contains an obligation, and then we can examine the detail. We can examine the detail. There is a put option that enables the shareholders to decide. The shareholders are in control. They can require us to pay the money back. So we do have an obligation. We have a contractual obligation to deliver cash. This must be regarded as debt for that reason. But I've only earned 3 marks, or at least I've only said 3 things. Now, night follows day. If we've classified it as debt, then there must be a finance cost. We are reporting the substance. These preference shares would be shown in non-current liabilities on the balance sheet, and the dividends that we paid would be regarded as a finance cost through the P&L. And if we didn't actually pay the dividend, we would accrue for that dividend. We would recognise it as a liability even though it hadn't been paid. There would be a 4% finance cost. This is the truth. Yeah? This is the economic reality. We must be faithful in representing and accounting the truth. Do you know what that animal is? It's a duck-billed platypus. It's a strange creature because it has fur, it suckles its young, and yet it lays eggs. So it's a little bit of a bird, it's a little bit of a mammal, it's a bit of a compound animal. It's strange. And what I want to move on to now is compound financial instruments. When we are issuing compound financial instruments and therefore having to apply split equity accounting. Now, what do I mean when I talk about compound financial instruments? I mean convertible loan notes. We are issuing what looks like debt, but embedded within the contract is an option that enables the holder to, at the end of the day, to ask for a fixed number of shares back. In other words, for them not to be repaid in cash, but to be repaid in shares. And this is an example of a compound instrument, and this is an example of where we are going to have to use split equity accounting, because the money we are receiving in on the issue of a convertible loan note is partly debt, partly money that we've borrowed that we have an obligation to pay back, but also embedded within that contract is an equity element, because there is the option that the holder has to convert to a fixed number of shares. This is not straightforward. So we've received money for issuing a compound financial instrument. We've received one lot of money, but effectively we've issued 2 financial instruments wrapped into one. So it's necessary to split out the debt and the equity elements because they are accounted for in very, very different ways. So we can measure the debt element at fair value. We can measure the debt element, the obligation element, at the present value of the future cash flows. We can work out the obligations to pay money out in the future, discount them back in today's monetary terms at the effective rate. Now that will give us a measure of the debt. And the equity element then becomes the balancing figure. It's so subjective valuing what the equity element would be worth. So we do it as a balancing figure. So what we need is an example. And Platypus is issuing a 2-year 5% convertible bond. So the bond will disappear after 2 years. It's issued at par, so we are receiving $10,000. The 5% is the coupon rate. So once again, we're paying $500 each time, each year out. Now the effective rate this time is 10%. There is no mention of any premium on redemption, so we can forget about that, not worry about that. It will be redeemed effectively at par if they want the money, or if they want the shares, they can have effectively 1-for-1, so they can effectively have 10,000 shares, and that would extinguish the liability. So this is the challenge. This is what we are going to be accounting for. And we're going to be explaining and showing what is going on. Now, in an exam scenario, where you've got explaining and discussing their words, where we've got showing and illustrating, they are numbers. And the majority of the marks are normally going to be weighted on the narrative, on the explanation. So I'm assuming a 3-2 split in this particular context. And I would always encourage you to explain and prepare the words first, and then the numbers are just simply backing it up. So, initial recognition. This obviously would have to be slightly polished and developed. The initial recognition of the $10,000 in respect of a convertible loan note has to be split into its debt and equity components. It's a compound, it's a complex financial instrument. And we do that by measuring the debt element at the present value of the future cash flow, so that the equity element, which is so subjective, we value it effectively as the balancing figure, as I'm about to illustrate in this particular question. Now, the subsequent accounting for the debt will be at amortized cost, and as we have already seen, the subsequent accounting for equity just doesn't really exist because it's not remeasured. If we're going to get involved in measuring the fair value, measuring the initial recognition of the debt, there is no market to observe, and therefore we need to do a calculation of the present value of the future cash flow. Now in year 1, the future cash flow is 500 because it's a 5% coupon rate on a 10,000 bond. The discount factor is 10%, so we are dividing by 1 over 1.1 or multiplying by 0.909 to give you, in this case, a present value of 45. But the second year's cash flow is not only the interest, but also the redemption of 10,000. Now that is being discounted at 1.1 to the power 2 to reflect the fact of the time value of money over the 2-year period, or you can multiply that by 0.8264, and you therefore are arriving at a measure of the debt initially at 9,133. That's the initial recognition of the debt. We, however, received 10,000. So therefore, the value of the equity is the difference between these two numbers. The value of the equity is the balancing figure. So we are debiting cash in the beginning of 10,000, but we're recognizing a non-current liability of 9,133, and we're recognizing an equity element, other components of equity, 867. So that's the initial split, and there would be a mark available for showing that, arriving at that calculation. But we've also got to show what happens in the first year. Now the equity element of 867, nothing happens to it in the first year, but the debt element of 9133 is subject to amortized cost. So it is subject to a 10% charge going through yeah, the profit and loss account, and you are paying the coupon rate, the 5% on the 10,000. So we have a closing balance, a liability on the balance sheet of 9546. Now, although this wasn't asked for, I'm here to teach, I'm here to explain. So let's run forward what happens in the second year. In the second year, you open up with your 9546. Your P&L is an extra 10%. I mean, I've rounded it to 954. You could argue it's 955, but in order to get it absolutely neat and spot on, yeah, when we pay the cash of 500, we're left with a 10,000 balance. Now at the year end, this is after 2 years, one of two things could happen to extinguish that liability, because that liability is about to disappear. On the one hand, we could have to pay them back the 10,000. Yeah, so we would reduce the liability by 10,000 and we would credit the cash 10,000 because we would pay them the money back. So that is one possibility. That's not our choice. We're obliged to do that. That's why we've shown it as a liability. Alternatively, if there is a conversion to equity, if the bondholders, the debenture holders want the shares instead, then we still extinguish the liability. We still got to debit the liability and we're crediting equity. We're crediting share capital by 10,000. All right. So either way, the debt disappears and either we've got less money or we've got more equity, just depending on what is decided by the bondholders, the debenture holders. Thank you for listening. I hope you now understand, what happens when we issue debt, when we issue equity, the distinction between the two, and how we can apply split equity accounting. One last thing. If you want further examples, why not access the ACCA Study Hub? And if you've liked this video, please put a comment. Thank you very much.